The global bond market has come under pressure after Moody's stripped the US government of its last top credit rating. However, plenty of governments are trying to reassure the markets about their creditworthiness. Let's get more from Gennadiy Goldberg, head of US rate strategy at TD Securities. Thanks very much indeed for joining us.
Thanks for having me.
Guys, Gennadiy, we have seen this phenomenon over the past few months. People not just worried about the US deficit, but the stability of government finances in Europe and Japan.
Yeah, I mean, you've really had a lot of folks worried about rising long-term interest rates across the world. I think part of that is influenced by rising deficits all around the world. You've seen Europe funding more. You've certainly seen rising interest rates as well, playing a big part of this. And certainly the rising deficit expectations for the U.S. are playing a big part as well. So you've seen term premium go up. You've seen lots and lots of nervousness. But I do think what you saw this morning or overnight with the Ministry of Finance potentially lowering some long-end issuance, I think plays very well into market fears and really helps allay some of those worries that deficits are just on an ever-rising trajectory and that the long end it will become unhinged.
The inflation, obviously a huge driver for long bond investors. How are they feeling? Are they worried about inflation over the next decade, say?
The question I get the most often is, for the Fed at least, will they be able to reach their 2% target? We think they will, at least over the next decade or so. Certainly the next year or two are going to be a little bit more difficult, given some of the trade uncertainty. I think over the next decade, I think 2% is still very much doable, especially if growth starts to moderate at a certain point because of all of this uncertainty. A lot of investors out there are worried that perhaps these, 2% inflation targets are a little bit too low. They're pricing in a lot more inflation premium, a lot more risk premium and term premium for holding on to this debt, which is steepening global yield curves, which is why I think, you're seeing rates move higher and higher across the world. But again, a lot of this will depend on what happens to global supply. And if that gets pared back, as we started to see with, the Ministry of Finance in Japan, for example, I wouldn't be surprised to see the long end come under a little bit of containment.
You do believe in this thesis that there's been a flight from U.S. assets, because obviously that would tend to push up the long-term yield on U.S. bonds and the cost of funding for the American government?
Well, I think between the downgrade from Moody's and some of the worries about deficits, there's definitely, and certainly trade uncertainty, lest we forget about that. There's definitely been a lot more questions being asked about, the long-term stability of U.S. finances, the long-term U.S. debt. I think right now it's more questions than actual flight. I was on the road in Europe talking to investors just a couple weeks ago. Most of the investors I talked to weren't materially changing their plans, but they were worried. It's a question that came up in just about every single meeting. Very few people were actually pulling money out. Most of them were basically discussing if they were to, where would they go? And unfortunately, there's not that many alternatives to the U.S. Treasury market. It's just in terms of depth and liquidity and size.
That's the thing, isn't it? Liquidity breeds liquidity. People go to active markets because they're active. What are you telling clients right now who wonder, well, should I go 5-year bonds or 10-year bonds, Gennadiy? I know it depends on the portfolio objectives, etc., but which look like the better buy in the U.S. market right now?
I think 5-year is already where a lot of the market participants are. There's a lot of folks out there who are in the kind of the 2 to 5 year part of the curve because it is somewhat lower risk. You are more attached to Fed funds expectations. Once you get out to the 10-year part of the curve, you're taking on a little bit more term premium risk. I think these levels, for about 450 on 10-year treasuries, 450 to 460 area is actually quite attractive on US 10s. Part of that is also because really twofold. One, we can see deficits being adjusted a little bit lower because the market is very worried about this. But if the Treasury comes out and starts to talk about potentially lowering long end issuance, much like the MOF, you could see a really big tailwind to the long end. The other part of this is also the refocus on economic data. As some of this hard data starts to come in, especially following Liberation Day, we could see a little bit of softness baked in, and the market will focus more on the data side rather than just deficits, as they've been basically solely focused in the last couple of weeks. So I could certainly see as the market reshifts its focus on economic data, you could see interest rates start to drift a little bit lower as well. So I think the 10-year part of the curve makes a lot of sense at this point.
And what about the 30-year? Who buys the 30-year actually, Gennadiy? People, I mean, do many people actually plan to hold a 30-year bond for 3 decades?
Well, you know, there's a lot of long-term investors out there who have longer-term liabilities, and they need to match those with long-term assets. What I think the issue is right now, it's not that there's a lack of investors. There's a worry that perhaps there's too much supply and too little demand. And I think that all comes right back to the U.S. Treasury. They have to do their surveying. They have to figure out if that is indeed the case. And to see if perhaps they should trim back long-end auction sizes. I could certainly see Treasury Secretary Bessent coming out maybe as soon as the August refunding meeting, or maybe even sooner, and discussing potentially trimming back 20 and 30-year issuance just marginally and encouraging markets. And that would really draw some cash right back into the U.S. long end.
And finally, Gennadiy, the current interest rate environment, is it favorable for big insurance companies, for example, who like to have assets that will deliver reliably for decades? Is it attractive for the big funds like that? I know it's a very broad question.
That's very fair, and it is a broad question, but I think it is. Higher interest rate environments do tend to be favorable for a lot of long-end investors. Investors like that tend to prefer corporate debt for a very long period of time. And as you have higher interest rates and, of course, wider corporate bond spreads, a lot of these investors will go into longer dated assets and will lock them in effectively at these more favorable levels. So I think from an all-in yield standpoint perspective, I think it's a very attractive environment for these long-end investors. And they are doing their own asset reallocations, potentially from risky assets to actually something a little bit less risky like bonds.
Gennadiy, thank you very much indeed.
Thanks for having me.
Gennadiy Goldberg is head of U.S. rate strategy at TD Securities. Coming up, hot picks. We are